Crypto investing is more than simply buying digital tokens and hoping their price goes up. At its core, investing in cryptocurrency means engaging with a broad set of financial decisions, understanding the technology and economic model that underpin digital assets, developing a clear purpose for why you are allocating money to crypto, choosing how much of your overall savings it should represent, selecting the mechanisms by which you will hold or use those assets, and managing the ongoing responsibilities that come with ownership. True investing blends research, planning, risk management, and active stewardship. It includes not only purchasing, but also deciding whether to hold long-term, periodically add to positions, earn returns through available financial services, or rebalance exposure as markets and personal circumstances change. In other words, buying coins is one transactional moment inside a larger process that encompasses strategy, security, taxation, and emotional discipline. The potential rewards of crypto investing can be significant, but they come paired with substantial uncertainty. Investors may capture outsized capital growth if the assets they own rise in market value, and some crypto positions can also generate income through protocols that support staking, lending, or yield generation. Beyond direct returns, crypto can offer diversification if its price movements are not perfectly correlated with traditional markets, and it opens access to novel financial systems and capabilities that did not exist before. However, these upside possibilities live alongside real and varied risks. Price volatility is extreme compared with many traditional assets, meaning large gains can be accompanied by steep drawdowns. Security risks are prominent. Mismanaging private keys, falling for scams, or relying on insecure platforms can result in permanent loss. Regulatory changes and legal uncertainty can alter market dynamics and access. Liquidity risks can make it difficult to exit positions at an acceptable price, and technological or protocol failures can create unexpected outcomes. Responsible investing requires acknowledging both these reward paths and the multiplicity of risks so you can plan accordingly. This guide will walk you through a clear, practical sequence tailored for someone starting from scratch. Chapter 1 focuses on building a foundational understanding so decisions are informed rather than impulsive. Chapter 2 helps you define concrete objectives and how crypto fits into your broader financial life. Chapter 3 explains how to choose and set up the right tools, exchanges, wallets, and basic security practices so you can transact safely. Chapter 4 covers simple, repeatable allocation and risk management techniques you can use from day one, and Chapter 5 outlines ongoing practices for learning, monitoring, and adjusting your plan as your knowledge and the market evolve. Each step is presented to reduce avoidable mistakes, prioritize security, and help you progress with confidence from curiosity to active, responsible investing. Let's begin by uncovering what cryptocurrency truly is, how it works, and the different types that shape this fast-growing digital economy. Cryptocurrency is a form of digital money that operates on decentralized networks powered by blockchain technology. Unlike traditional currencies issued by governments and managed through banks, cryptocurrencies exist as purely digital assets secured through cryptography. Each transaction is recorded on a public ledger called the blockchain, which ensures transparency, prevents duplication, and maintains trust without requiring essential authority. This technology allows people to send and receive value directly, peer-to-peer, anywhere in the world, without intermediaries controlling or validating the process. It is a revolutionary concept because it merges financial systems with advanced computer protocols, allowing money, ownership, and contracts to exist as digital data that cannot easily be manipulated or forged. Among the vast number of cryptocurrencies, some names stand out due to their influence and adoption. Bitcoin, the first and most recognized cryptocurrency, introduced the idea of a decentralized form of money with a fixed supply. Ethereum expanded this idea by allowing developers to build decentralized applications and smart contracts on its blockchain, enabling innovation beyond simple currency transfers. Stablecoins, such as USDT and USDC, are designed to maintain a stable value by being pegged to traditional currencies like the US dollar. They provide a bridge between traditional finance and the crypto ecosystem, allowing users to transact in digital form while avoiding extreme price volatility. Each of these plays a specific role in the digital economy: Bitcoin as a store of value, Ethereum as a programmable infrastructure, and stablecoins as a reliable medium of exchange. People are drawn to cryptocurrency for several key reasons. The principle of decentralization appeals to those who value financial systems that are open, transparent, and not subject to the control of banks or governments. The growth potential of this emerging market offers the possibility of significant returns for early and informed participants. Beyond profit, there is also the pursuit of financial freedom. Cryptocurrency empowers individuals to hold, move, and manage their assets independently, often across borders, without restrictions or intermediaries, and represents not just an investment opportunity, but also a movement toward self-sovereignty and financial innovation, where individuals take greater control of their economic future. As a beginner, it is essential to recognize that not all cryptocurrencies are the same. Understanding their types helps you make informed choices about where to allocate your funds. Coins are digital currencies that operate on their own independent blockchains. They serve as the foundation of their respective networks and often act as both a means of payment and a store of value. Bitcoin and Ethereum are the most prominent examples of coins, as they maintain their own blockchains and secure their systems through decentralized consensus. Tokens, on the other hand, do not have their own blockchains. They are built upon existing blockchain infrastructures, most commonly Ethereum, using predefined standards like ERC-20. Tokens can represent various things: assets, access rights, or even governance power within a project's ecosystem. They rely on the security and functionality of the blockchain they are built on, making them easier and faster to create, but dependent on the stability of the host network. Stablecoins occupy a unique position because they are designed to counteract volatility. By being pegged to a fiat currency, they provide stability and act as a safe zone during market fluctuations. Investors often hold stablecoins to preserve value, transact easily between different exchanges, or temporarily exit volatile markets without converting back to traditional money. They maintain predictability, which is crucial for trading and liquidity. Lastly, there are utility tokens and meme coins, which carry higher risks. Utility tokens grant holders access to specific services or products within a blockchain ecosystem, while meme coins often emerge from internet culture and speculative hype rather than strong fundamentals. Their value tends to fluctuate sharply, driven mostly by social trends and investor sentiment. Beginners must approach these assets with caution, as they can experience rapid price swings and may lack sustainable value. Understanding these categories, coins, tokens, stablecoins, and high-risk speculative assets, forms the foundation of informed investing, ensuring that every decision aligns with knowledge rather than emotion. Having understood what cryptocurrency truly is and the various types that exist, you now possess the foundational knowledge needed to recognize the diversity of the digital asset world. You've seen how coins, tokens, and stablecoins function differently and how each serves a unique purpose within the broader blockchain ecosystem. The next critical step is learning how to participate safely in this new financial landscape. To begin investing confidently, you must understand where and how to buy, trade, and store your assets securely. This brings us to the next chapter, where you'll discover how to choose a reliable crypto exchange and protect your investment from potential threats. Choosing a reliable crypto exchange is one of the most important first steps in your journey as a beginner investor. A crypto exchange serves as the marketplace where you buy, sell, and sometimes store your digital assets. However, not all exchanges operate with the same level of security, transparency, or regulatory compliance, which is why selecting a trustworthy platform is critical. When choosing an exchange, focus on established, well-regulated, and globally recognized names, such as Binance, Coinbase, or OKX. These platforms have proven track records, advanced security systems, and a large user base, which together help reduce the risks associated with trading in unregulated environments. A reputable exchange provides liquidity, stable trading infrastructure, and responsive customer support, all of which are essential for a smooth investing experience. Most legitimate exchanges require users to complete a process known as KYC, Know Your Customer, verification before trading. This process involves submitting identification documents and, in some cases, proof of address. KYC is not just a regulatory requirement, it also protects users by preventing fraud, money laundering, and account misuse. Completing KYC ensures your account is verifiable and your transactions are traceable, giving you more security in the long term. In addition to verification, it's essential to understand an exchange's fee structure before trading. Different platforms charge varying rates for deposits, withdrawals, and trades. Transparent and reasonable fees are a sign of a legitimate exchange, whereas hidden or unusually low fees can indicate potential risk. Security features are another critical aspect of selecting a trustworthy exchange. Two-factor authentication, or 2FA, should always be enabled to add an extra layer of protection to your account. This feature ensures that even if someone obtains your password, they cannot access your account without the secondary verification code generated on your personal device. Other security indicators to look for include withdrawal whitelisting, anti-phishing codes, and insurance funds that protect users against system breaches. Finally, avoid using unverified or obscure platforms that promise unrealistic returns or lack clear ownership details. These are often breeding grounds for scams and fraudulent activities. Sticking to reputable exchanges minimizes the chance of losing your investment to manipulation or security breaches. Once you have purchased your cryptocurrencies, securing your investment becomes your next and most vital responsibility. The golden rule in the crypto world is simple. Never leave your funds on an exchange longer than necessary. Exchanges, no matter how reputable, are still online platforms vulnerable to hacking or operational failure. When your assets remain on an exchange, you don't have full control over them. The exchange does. To truly own your crypto, you must transfer it to a personal wallet where only you hold the private keys. This step is what turns you from a user into a true investor and custodian of your assets. Crypto wallets come in two main categories: hot wallets and cold wallets. Hot wallets are connected to the internet and are generally available as mobile or web-based applications. They offer convenience and ease of access, making them suitable for small amounts or daily transactions. However, because they are online, they are more exposed to cyber threats and phishing attacks. Cold wallets, on the other hand, are offline storage devices that keep your private keys completely disconnected from the internet. They are considered the safest form of storage for long-term investors since they are immune to most forms of online hacking. Popular hardware wallet brands like Ledger and Trezor are known for their robust encryption and user-friendly interfaces, making them ideal choices for anyone serious about protecting their crypto holdings. Securing your investment also involves responsible backup management. When you set up a wallet, you will receive a seed phrase, a unique series of words that acts as the master key to your assets. This phrase must be written down and stored safely offline, never shared, and never saved digitally on devices connected to the internet. Losing your seed phrase means losing access to your funds permanently, while exposing it to others can result in theft. Step 1 in wallet security is recording the seed phrase accurately. Step 2 is storing it in multiple safe, offline locations. Step 3 is ensuring no digital trace of it exists. By following these steps and maintaining discipline in your security habits, you build the foundation of safe investing, one where your crypto remains truly yours, protected from both technical failure and human error. Now that you know how to select trustworthy exchanges and have learned the importance of securing your funds through proper wallet management, you're ready to start building your investment foundation. Security and reliability are the bedrock of every investor's success, but what comes next is learning how to invest wisely. The next chapter will guide you through the practical side of crypto investing, how to begin with small, manageable amounts, diversify your portfolio, and apply simple yet effective strategies to grow steadily in this volatile market. Starting small and diversifying are two of the most fundamental principles every beginner must understand before venturing into crypto investing. The crypto market is known for its volatility. Prices can fluctuate dramatically within hours or even minutes, so entering with a cautious mindset is essential. The best way to begin is by investing only what you can comfortably afford to lose. This approach protects you from financial stress and emotional decision-making, allowing you to focus on learning the dynamics of the market rather than fearing every price swing. Starting small helps you gain experience, understand how exchanges work, and become familiar with wallet management without exposing yourself to unnecessary risk. It's not about how much you invest initially, it's about learning how to invest properly. Once you begin, diversification becomes your primary tool for managing risk. Placing all your funds into one cryptocurrency might seem tempting, especially when you see strong market movements, but it exposes you to significant loss if that particular asset declines. Diversification means spreading your investment across multiple reputable assets so that one coin's performance does not entirely determine your portfolio's outcome. In crypto, this often involves allocating a major portion to well-established coins like Bitcoin and Ethereum, as they represent the backbone of the market with more stability and long-term credibility. The remainder can be distributed among smaller cap projects or stablecoins to balance potential growth and risk. A simple structure, such as dedicating about 60% to Bitcoin, 30% to Ethereum, and the remaining 10% to smaller coins or stable assets, provides a strong foundation for beginners. This type of allocation reduces exposure to sudden market downturns while still allowing for growth opportunities. Learning basic investment strategies is the next critical step in developing a disciplined approach to crypto investing. One of the simplest and most effective strategies for beginners is dollar-cost averaging, or DCA. This method involves investing a fixed amount of money into your chosen assets at regular intervals, weekly, bi-weekly, or monthly, regardless of price fluctuations. Step 1 is to decide on a fixed amount that fits comfortably within your budget. Step 2 is to set a consistent schedule for investing, and Step 3 is to stick to it regardless of market conditions. Over time, this strategy smooths out price volatility by averaging your purchase cost, allowing you to build your portfolio gradually without the pressure of timing the market. It promotes consistency and emotional stability, which are key traits for long-term success. The next strategy, often summarized by the term HODL, focuses on long-term holding. This approach involves identifying strong, credible projects and holding on to them through market ups and downs, believing in their long-term growth potential. HODLing removes the stress of short-term price changes and aligns with the broader vision of cryptocurrency as a transformative financial technology. It requires conviction, research, and patience. The most successful investors understand that markets move in cycles and that the greatest rewards often go to those who can wait through periods of uncertainty without reacting impulsively. For those who want to explore beyond passive investing, trading is another strategy, but it is not suited for complete beginners. Trading involves buying and selling crypto assets based on price movements, requiring a deep understanding of technical analysis, market trends, and risk management. It demands time, focus, and emotional control, as mistakes or emotional reactions can quickly lead to losses. Beginners are encouraged to first focus on learning and practicing with small amounts before attempting active trading. Across all these strategies, emotional control and patience are your greatest assets. Crypto markets can evoke excitement when prices rise and fear when they fall, but emotional decisions often lead to poor outcomes. Step 1 is to accept volatility as part of the environment. Step 2 is to follow your investment plan consistently, even when the market tests your confidence. Step 3 is to keep learning and adjusting based on data and experience, not emotion. By starting small, diversifying wisely, applying simple strategies like DCA or HODL, and maintaining emotional discipline, you establish the habits and mindset that form the foundation of long-term success in cryptocurrency investing. After gaining clarity on how to start small, diversify intelligently, and apply proven strategies like DCA and HODL, you now have the structure of a disciplined investor. You've learned that emotional control, patience, and consistency are as important as the assets themselves. But successful investing doesn't end there. It evolves through continuous learning and informed decision-making. To navigate this fast-changing space, you must know how to analyze information critically and understand market patterns. The next chapter will help you master research and market awareness so that your choices are guided by knowledge, not noise. Doing your own research, often abbreviated as DYOR, is one of the most crucial habits to develop when investing in cryptocurrency as a beginner. In this market, information travels fast, and not all of it is reliable. Many new investors fall into the trap of following hype, rumors, or the loud voices of so-called crypto influencers, who may have hidden motives or limited understanding of what they promote. DYOR means taking personal responsibility for verifying information before investing your money. It's about cultivating independent judgment and avoiding emotional decisions driven by excitement or fear. Step 1 is to question every claim you encounter. Step 2 is to investigate whether the project truly adds value to the crypto ecosystem. Step 3 is to make investment decisions only after confirming that the fundamentals align with your goals and risk tolerance. By adopting this mindset, you protect yourself from scams, pump-and-dump schemes, and misleading marketing narratives that often circulate in the industry. To perform proper research, you need to evaluate several key elements of any cryptocurrency project. The first is its white paper, a technical document that explains what the project does, how it works, and what problem it aims to solve. Reading the white paper helps you understand whether the project has a real purpose or is simply riding on hype. Next, examine the team behind the project. Look for transparency in their identities, professional experience, and track record in blockchain or related fields. Strong, visible leadership often indicates credibility, while anonymity or vague information may be a red flag. The use case is another vital factor. Ask yourself what real-world problem the project addresses and whether there is genuine demand for its solution. Finally, analyze tokenomics, the economic structure that governs how tokens are created, distributed, and used. This includes supply limits, distribution plans, and mechanisms for maintaining value. A well-designed tokenomics model ensures sustainability, while a poorly structured one can lead to inflation or unfair advantages for early insiders. There are reliable tools that can assist in your research process. Websites like CoinMarketCap, CoinGecko, and Masari provide comprehensive data on market capitalization, trading volume, price history, and project fundamentals. They also link to official websites, social media accounts, and community pages, helping you verify information from primary sources. Using these tools consistently allows you to track market trends and compare projects based on objective data instead of speculation. DYOR is not a one-time activity, it's an ongoing discipline. The more you research, the sharper your instincts become, enabling you to distinguish genuine opportunities from risky distractions. Understanding market cycles is another vital skill for anyone learning how to invest in crypto as a complete beginner. The cryptocurrency market, like all financial markets, moves in cycles that alternate between periods of expansion and contraction, commonly known as bull and bear markets. A bull market is characterized by rising prices, growing investor confidence, and increasing participation. It's a time when optimism dominates and many assets reach new highs. A bear market, on the other hand, is marked by declining prices, reduced trading activity, and widespread caution or fear among investors. Recognizing which phase the market is in helps you make rational decisions and avoid emotional reactions. In a bear market, it's easy to feel discouraged when portfolio values decline, but this is precisely when patience and strategy matter most. Panic selling during downtrends often leads to unnecessary losses, especially if you are holding solid projects with long-term potential. The market naturally goes through corrections, and understanding this cycle allows you to stay calm and make decisions based on analysis rather than fear. Step 1 is to identify the broader market trend using credible data sources. Step 2 is to maintain your investment plan even during uncertainty. Step 3 is to see downtrends as opportunities for learning or gradual accumulation, rather than as moments of defeat. Another important concept to understand is alt season, a period when altcoins outperform Bitcoin in terms of price growth. Alt season typically occurs when Bitcoin's dominance in the market begins to decline, leading investors to shift capital into smaller projects with higher potential returns. While these periods can generate strong profits, they also carry higher risks, as altcoins tend to experience sharper corrections afterwards. Monitoring Bitcoin dominance, which measures Bitcoin's share of the total cryptocurrency market capitalization, helps you recognize these shifts. A rising dominance often signals a market moving back towards stability and Bitcoin strength, while a falling dominance can indicate growing appetite for altcoin speculation. By understanding market cycles and staying grounded through DYOR, you gain the clarity and discipline needed to navigate volatility. You begin to see beyond short-term price movements, recognizing that crypto investing is not about chasing trends, but about understanding patterns, managing risk, and positioning yourself wisely in each phase of the market. With a strong grasp of how to conduct your own research and recognize the patterns that define bull and bear markets, you've stepped into the mindset of a strategic investor. You now understand that timing, analysis, and patience work together to shape your success over time. Yet the journey of crypto investing doesn't stop with knowing the market. It continues with adapting to its constant evolution. In the final chapter, we'll focus on staying updated, learning continuously, and following guiding principles that will help you maintain security, discipline, and long-term confidence as you grow in the world of cryptocurrency. The world of cryptocurrency evolves at an incredible pace, with new projects, technologies, and regulations emerging almost daily. What seems relevant today may become outdated in a few months, so the key to becoming a successful crypto investor is to keep learning and staying consistently updated. The crypto space is not static. It is an ever-changing ecosystem shaped by innovation, competition, and global adoption. As a beginner, continuous learning keeps you informed and adaptable, enabling you to make sound decisions even in uncertain or fast-moving conditions. Step 1 is to build a routine for consuming reliable information. Step 2 is to verify that your sources are credible and fact-based, not driven by speculation or promotion. Step 3 is to apply what you learn gradually, refining your strategy as your understanding deepens. Following trusted news outlets and analytical platforms helps you stay aware of market developments and technological advancements. Reputable sources such as CoinDesk, The Block, and Cointelegraph provide professional coverage on blockchain innovation, government policies, exchange updates, and market trends. Educational platforms like Crypto Education Zone, or CEZ, simplify complex topics into practical knowledge, helping you strengthen your foundation without the noise of hype-driven commentary. In addition to reading news, engage with blockchain reports, developer updates, and institutional research to gain a broader perspective on how the crypto industry is maturing. Regulations also play a significant role in shaping market behavior, and staying informed about new laws or compliance measures in your region will protect you from legal or financial risks. The more informed you are, the more confident and calculated your investment decisions will become. Joining crypto communities is another effective way to learn and grow. These communities exist across platforms such as Telegram, Discord, Reddit, and X, formerly Twitter, where investors, developers, and enthusiasts share insights, discuss new trends, and analyze market conditions. Engaging with these groups allows you to learn from the experiences of others, ask questions, and gain perspectives that may not be covered in traditional articles. However, participation should be done thoughtfully. Focus on communities that emphasize education, transparency, and verified information, rather than those that promote hype or price speculation. Step 1 is to listen and observe discussions before forming conclusions. Step 2 is to contribute only when you have verified facts or genuine questions. Step 3 is to filter noise by aligning with sources that match your values and long-term goals. By maintaining this balance, you remain informed while avoiding misinformation or emotional influence from the crowd. As you reach the final stage of your beginner journey, it's important to internalize a few guiding principles that will sustain your growth as an investor. Always invest with logic, not emotion. The crypto market is highly reactive, and emotional decisions, whether driven by fear during a crash or greed during a surge, often lead to regret. Logical investing means relying on research, strategy, and data, not impulses. It involves having a clear plan for entry, exit, and risk management, and sticking to that plan regardless of short-term fluctuations. Emotional discipline separates serious investors from gamblers in this space. Never invest borrowed money under any circumstances. The volatility of crypto means prices can swing dramatically without warning, and using debt amplifies both gains and losses. When losses occur, and they inevitably will in some form, owing money can turn a manageable setback into a financial crisis. Step 1 is to invest only disposable income that will not affect your essential needs. Step 2 is to treat crypto investing as a gradual journey, not a race. Patience and consistency build wealth far more effectively than risky shortcuts. Above all, always prioritize security over hype. No amount of potential profit is worth compromising the safety of your funds or personal data. This means using trusted exchanges, securing your private keys, avoiding suspicious links or offers, and keeping your wallet backups offline. New investors often get drawn into projects promising quick returns, but true success in crypto comes from protecting your capital first and growing it steadily over time. Security is not a one-time action, it is a continuous mindset. When you combine knowledge, logic, security, and patience, you move beyond just being a participant in crypto. You become a disciplined investor. The journey may begin with curiosity, but through consistent learning, cautious investment, and rational decision-making, you'll build the confidence to navigate this digital economy wisely and sustainably. If you found this video helpful, don't forget to like the video, subscribe to Crypto Education Zone, and hit the notification bell so you never miss out on more insights. And remember, knowledge is your greatest asset in this space. Keep learning, keep questioning, and keep building your conviction.